Okay, guys, this is chapter 14, adjustments and the worksheet for merchandising business. You guys have already done adjustments on a worksheet in accounting 1. This is just a little different because it's for a merchandising business. So the first thing we're going to do is prepare an adjustment for merchandise inventory using our periodic inventory system, which we talked about a chapter ago. The worksheet for a merchandising business is similar to a service business worksheet that mainly just works in the service area. That means it doesn't have a lot of inventory on the shelves. It's used to record adjustments, including merchandise and unearned revenue. It's used to prepare financial statements as well, your statement of owner's equity, balance sheet, and income statement. So here's an example. Ponder's Bike Parts has a beginning merchandise inventory of $25,000 at the end of the accounting period and a physical inventory when they went through and counted their physical inventory of merchandise, determined that the merchandise costing $30,000 was still on hand. So they started the year out with $25,000 worth of inventory, and at the end of the accounting period, they physically counted their shop worth of merchandise and $30,000 was still on hand. So there's more inventory at the end of the year than the beginning of the year. When purchases exceed sales, the inventory balance is higher at the end of the year. So basically, doesn't mean we sold less, it just means that we purchased more than we sold. So this is what the adjustment for merchandise inventory is going to look like. Each end of the period, we have to make that inventory balance ready for the next period. So the beginning balance of last year left a debit of $25,000 in their inventory in their store. We went through and counted, and now we have $30,000, so we have to adjust it $5,000. We're going to do that by, since it is a periodic inventory system, our merchandise bought during the year is debited to purchases instead of merchandise inventory. So we're keeping our purchases separate. That $5,000 difference will show up in a little bit. So we have a purchases, however much it was, the cost of merchandise sold is not recorded. The selling price is credited to the sales account. Whoops. So after a year of purchasing and selling merchandise, the balance is no longer accurate, which means we need to adjust it. It's a two-step adjustment. And they want us to look at the adjustment on a partial worksheet. So this is just your trial balance, and this is where your $25,000 is going to show up in your debit side. If you see the debit of $25,000, this is the trial balance before the adjustments are made, and then after the adjustments are made, you'll have your post-closing trial balance. So step one is to remove our beginning inventory. We have to take that $25,000 away. So it's a $25,000 credit that's going to cancel out that $25,000 debit, making merchandise inventory 0. And then to correspond with that debit, we have a $25,000 debit to go with our $25,000 credit. With each debit, we have to have a credit. So with our credit that cancels out our debit, we have to also put $25,000 in income summary. This is also in your text. You can follow along probably a little easier. But the next step is entering the current ending inventory that we counted in our store of $30,000. So we need to adjust that by putting it in the debit column where that $25,000 used to be. Now $30,000 is being adjusted to that spot. And just like the rest of them, with every debit we have to have a credit. And that $30,000 is going to go in income summary. Technically, that's a $5,000 adjustment. but we can't just adjust it $5,000. We have to take it out and put back in a different amount. So now in our adjusted trial balance, those two $25,000 debits and credits, they cancel out each other. And we are left with a $30,000 debit. Our income summary, there's a specific rule, and we don't cancel them out. They just transfer straight over and across. So be careful with income summary, both beginning and ending inventory accounts amounts. They're extended straight across to the adjusted trial balance column. This is the only column that will do this, so be sure and take them both straight across. So you'll have a debit balance and a credit balance for your income summary in the adjusted trial balance. So the rest of these that aren't adjusted just transfer over, just like usual with your old worksheets. If there's no adjustments to be made, they just go straight over with no adjustments to the adjusted trial balance column. So then, same as usual, merchandise inventory is extended to the balance sheet column, not the income statement column. Your income summary, both beginning and inventory amounts are extended to the income statement column, as with the rest of it. So anything above merchandise inventory is going to go to your balance sheet. Anything below is going to go to your income statement. Cost of goods sold from last chapter can be computed from the income statement columns. And this is part of our income statement here. You can find your cost of goods sold by taking your beginning inventory. That was our beginning inventory January 1st of $25,000. We stick our purchases in as $80,000, but before we add that to our merchandise, our beginning merchandise, we have to subtract any returns and allowances of $1,000 and any discounts of $500. So that's a total of $1,500 that we have to subtract from our purchases. It gives our net purchases a total of $78,500. And then any freight is also added into that. So now we have cost of goods purchased, $79,200. So with what we started with at the beginning of the year of $25,000 and what we purchased throughout the year of $79,200, we have goods available for sale this year of $104,200. What we didn't sell is what we have left in our inventory December 31st, and that is $30,000. So we have to subtract that because we didn't sell it. So we subtract that from what we had available for sale for the year, and we're left with a cost of goods sold amount of $74,200. Okay, this is section number 2. It's preparing an adjustment of unearned revenue. So here's the example. Brown County Playhouse sells season tickets. Tickets sell for $10 for each play, or $50 for a 5-play season ticket. And a maximum of 1,000 seats can be sold for each play. Let's assume that all the shows sell out during the first week and that season tickets are available. So when season tickets are sold, these tickets are sold out. So they have $50,000 of unearned revenue. These people have not paid for their tickets yet, but they will pay for them when they get there. So they have $50,000 of tickets spoken for but not paid for. So when the tickets are sold, cash is going to be debited and the unearned ticket revenue is going to be credited. So following the production of the third show, they're paid for, they're purchased, but they're just not earned yet. Okay? So following the production of the third show, financial statements are to be prepared. So there's 3 shows. We have to adjust our first show because it's already over and the other 2 are still unearned. But their first show, since it's already over, is earned revenue at this point. So when adjusting entries is recognized the ticket revenue for 3 shows. So $30,000 from the first show is done. There's 3 shows, 1,000 tickets per show, so that's 3,000 tickets. 3,000 tickets times $10 per ticket is $30,000. So $30,000 in revenue is removed from the unearned account and put into the revenue account. So it's earned after the show, so that $30,000 is not unearned anymore. It's now revenue. We've earned it. So now our unearned ticket revenue balance is now $20,000, and we have a $30,000 ticket revenue balance. So let's look at our chart of accounts. For a merchandising business, we always have merchandise inventory. That's going to be your new account that's not usually in your worksheet, but it only is for a merchandise selling business. In the liabilities section, you have unearned revenue. Unearned subject revenue is anything that you sell that you earn later. So shows are a really good example of that. Sporting tickets, like Denver Bronco tickets, they aren't earned until the game is played. On our revenue side, we have revenue, sales, returns, and allowances. That is what we take away from sales when anything is returned. And then our expenses, they consist of our cost of goods sold, which is purchases, purchase returns and allowances, purchase discounts, and freight in. And you can see the rest of them there as well. It's a pretty large chart of accounts when you get to working with merchandising businesses. So the last thing we're going to do is prepare a worksheet for a merchandising business. First of all, we're going to prepare the trial balance, which should be done for you in most of your homework. The next thing we're going to do is prepare the adjustments. And then we're going to do the adjusted trial balance just like all the worksheets we've done in Accounting 1. And then we're going to extend that adjusted trial balance to either the income statement. Remember, everything above merchandise inventory goes to the income statement, and everything below goes to the balance sheet. So the total income statement and balance sheet columns, they're going to be used to compute our net income or net loss.